Investment flows in any direction being threatened by tighter credit markets and as global investors retreat to perceived safer regions. What does this spell for capital flow onto the African continent and in the thrust of its developmental era? And what role in this regard do developmental organizations play? Well, Andrew Alli, CEO of the Africa Finance Corporation, joins us now to take us through their plans specifically. Thanks so much, Andrew, for joining us this afternoon. Well, reading through a report by the African Finance Corporation, first and foremost, it highlights how, despite improved governance and macroeconomic conditions, Africa's share of global private infrastructure investment has remained small. So what kind of void are we looking at that needs to be filled here?
Hi, Alicia. Thanks for having me here. It's estimated by the World Bank that the infrastructure investment needs of Africa something like about 80 billion US dollars a year. Of this, various sources, mainly the governments themselves, provide something like 50 billion. So the void that is needed to be filled is something like 30 billion a year. Obviously, the flows that are coming in are far less than this.
Well, enter the AFC. I mean, on a comparative basis, how do returns here compare to some of the returns you're expected to reap from the more developed markets? What exactly is enticing you this way when it comes to return on investment?
Well, I think, again, numerous studies that have been done have shown that returns on investment in Africa are actually a lot higher than those in other regions, even in Asia. For example, returns on private equity investments, just as one example, about 25% per annum, which compares with something like, something in the teens that you would expect in the more developed markets for the same types of investments.
That return coming at what price, though? I mean, while there's substantial demand for infrastructure assets, specifically on the continent right now, and a lot of money is being directed that way, to what extent is there a concern around implementation and actual follow-through in seeing successful projects being realized?
Well, I think one of the issues that is faced in Africa is actually a lack of well-developed bankable projects. As you say, there is actually a fair amount of money from DFIs, from other interested investors that is looking to invest in Africa. Clearly, the demand for infrastructure is there, and people can pay for it, as has been demonstrated by telecoms. But one of the things that's missing is that there are just not that many well-developed bankable projects in which people can actually invest and expect to get their money back and make a good return. Part of this is due to poor regulatory environments in many sectors in many countries, but part of it is also due to a lack of expertise, a lack of experience, and a lack of capital to put together these bankable projects. That's why, for example, AFC has a group of people who specialize in project development, taking projects from the early stage to where they're bankable. And right now we're working on a 340 megawatt power plant in Ghana.
Well, let's take a look. I mean, you've just touched there on Ghana, but let's take a look at some of the territories you're going to be involved with and the two most prominent, because if we take a look at it, one assumes that there's going to be some bias towards Nigeria, given that major shareholders in AFC hold Nigerian citizenship.
Yes, a lot of our capital is from Nigeria, and our headquarters is also here in Lagos. So clearly we're seeing a lot of projects here in Nigeria, and we expect that a substantial proportion of our investments will be here. And we're looking at projects in the oil and gas sector, in the transportation sector, in the telecom sector, and in the port sector here in Nigeria, and of course not to forget the electricity sector. But we're also looking at investments as far afield as Cape Verde, where we're looking at something in the renewable energy sector. Kenya, also renewables project. South Africa in the road transportation sector, and places like Equatorial Guinea, where we're talking in early stages about investing in ports and other similar types of infrastructure.
Well, you've identified those sectors, with the view that that they hold high profit potential and developmental impact as well. Looking at your participation and involvement in these projects, I mean, you participate across the project life cycle, so to speak. What would be the determinants to when you actually pull out of the project? Is this full follow through to completion?
Yes, AFC, we position ourselves as a long-term investor. So we provide both equity investments, and for example, we are invested in the main one, fiber optic subsea cable project that just came live today, and we're very pleased about that because we think it will be very transformative in terms of internet access down the west coast of Africa. But we also participate in debt, and so for example we financed the Jubilee field development in Ghana with a 50 million loan. Generally speaking, for debt investments, we expect to stay there for the life of the debt that we've given, so between 7 and 10 years generally.
Yeah.
For equity investments, like any equity investor, we look to exit at some point so that we can recycle our capital and put it into other investments, and that point of exit really depends on how the project develops. But yeah. In fact, we actually, because we're not a private equity fund that has a limited life, we can actually spend a long time in a project in the equity if need be.
Well, that would mean then your capital's tied up for quite a while. Then what war chest are you sitting with for deploying onto the continent, and how is that fund expected to be maintained?
Well, we have currently we're sitting on $1 billion of capital, just over 1.1 billion to be precise, of which we've committed something like $200 million to long-term investments. So we have firepower of another 800 million. We expect to be able to go and raise leverage in the future, so we'll be able to replenish it through leverage and also through recycling the profits on our investment.